Hi Justin.
Hi Cameron.
Thanks for talking to us today. You're back in Australia talking to clients and investors about the risks and opportunities of investing in sub-investment grade credit. Before we get started with the themes, what does opportunistic credit mean at Shenkman?
Yeah, so I'm thrilled to be back here in Australia to talk about Shenkman and the opportunistic business. Our goal in opportunistic is to take advantage of intermittent volatility within the leveraged finance market by leveraging Shenkman's infrastructure based on the 36 billion and 150 team members that we have on the team. Our goal is really to achieve low double-digit returns by taking advantage of mispricings that occur in the markets when you see idiosyncratic news.
All right, great, thank you. Well, let's get stuck into it then. We're noticing some cross currents within credit markets at the moment. Where do you think the divergences will be, and take into account themes such as tariff tensions and the impact of AI? How do you see that playing out in credit markets?
Sure, over the last 5 to 10 years in credit, it's really been a beta-oriented market. Everything has gone up or down together. When you think about tariffs and technological dislocation, you're going to start to see a lot more idiosyncratic news where some companies will really benefit from technology changing and their ability to adapt to it, and some will see their supply chains disrupted from tariffs, and you'll see some real challenges that occur in many of those types of companies. And so knowing each individual company and how they're going to behave in those environments is going to be critical as we move forward.
So you touched upon idiosyncratic risk, so let's compare that with systemic risk. How do you see that playing out in markets as well?
Yeah, so systemic risk as we sit today is clearly very elevated. Whether it be the global international wars that we're experiencing or the individual tariff discussions that are happening, we're likely to continue to see those play out. However, the most important part really will be where rates are. We've been in a higher rate environment for a longer period of time, and I think you're going to likely start to see that play out in the credit environment where companies will start to struggle given that the hurdle rate for their businesses has now been higher for a couple of years.
So taking into account the higher for longer, as you just referred to, are you seeing companies in effect buying time with the upcoming maturity walls and using liability management exercises to really extend and work through some of their issues? And how do you see that playing out, risks, opportunities for you as an investor in this space?
Yeah, so I break apart the market into two parts. One, most companies that can extend maturities already have. And so we don't really have a maturity problem within the marketplace.
So moving to AI and the potential impacts in your part of the investment universe, how are you seeing AI impacting the companies that you invest in, and how do you see that playing out in terms of risks and opportunities for investors?
Sure, I think that where you're really seeing AI play out right now is in the equity markets and the valuation of the companies that are directly creating much of the AI. It will take a little while for it to move over to the credit space, where most of it you'll see it in dislocation, right? Whether that be employee dislocation so you can do things more efficiently, or whole businesses get dislocated because things can get done much easier. Those are going to be very hard to project going forward. I think from an opportunistic standpoint, what we want to do is we want to react quickly. We want to see how AI plays out, see where it's impacting these companies, and then either be able to go long or short based upon the opportunities that present themselves as they go forward. But this is going to be a trend that's going to be with us for a long time, and it's going to have very significant impacts across the marketplace.
Okay, so moving from the long term into perhaps the short to medium term, trade tensions, policy shifts, how are you seeing that playing out through the credit markets from your perspective, and what are the opportunities there potentially?
Yeah, so when we think about tariffs and the individual negotiations that are happening within countries, I don't think anybody at this stage can project exactly how they're going to play out. However, it is going to create some challenges. What areas we're looking to avoid are areas maybe more cyclical in nature, where supply chains are likely to get disrupted. You own big plants, it's going to be hard to move those around or very costly. And if you're levered, that's just going to add an additional burden to what has historically already been a volatile part of the asset class. So I think that's going to be an area that we're going to want to be very careful of and defensive, especially when you consider where spreads are today, where they're not really pricing in a lot of that additional risk. So we want to be careful there. For other areas of the market, I think in U.S. high yield, it is shaded and protected a bit from some of the things going on in the tariff world because so much of it is U.S. based and U.S. based companies.
Thanks, Justin. Covered a lot of ground there. Enjoy the rest of your trip in Australia.
It's been a pleasure. Thanks so much, Cameron.
Thank you.